investors have their attention fixed on today's 228 billion T-bills auction for the bond side. Traders at Axis Bank expect cherry picking to persist, although on a less aggressive note given the bond auction settlement. Oladimeji Obasa, Treasury Team Member at Axis Bank, joins me now for more midweek market movement. Thank you so much for your time today, Dimeji, and quite an interesting week in the markets. But let me get your thoughts on some of the, the bond auction, the T-bills auction, sorry, and also the bond auction from Monday.
Thank you very much for having me. Yes, we did start this week on a quiet note. However, we've seen activity in the fixed income market increase significantly, particularly in relation to the previous trading sessions, starting from yesterday. And this is as a result of the bond auction, where we saw yields increase significantly, particularly on the longer end of the curve, with the 2033 bond closing as high as 21.5%. We've seen that bond trade to about 21.15% levels, where it's currently trading in secondary market. So that high that high yield from the bond auction spurred a lot of market activity, which we've seen from yesterday's trading session as well as today's trading session. Like you've noted, today is there's a Treasury bill auction today that is organized by the DMO, where the three standard tenors will be on offer. That's the 91-day, 182, and 364-day maturities. The general consensus is for the longer end of the curve, of the Treasury bills curve, which will be the new 364-day bill, to take the bulk of market attention. We expect that bill will close today's auction at around 20.5% levels, or maybe slightly lower, given the increased interest that we've seen in the fixed income market so far.
All right, now we're seeing the liquidity trends so far in the market this year as we're winding up this second half of the year. Let me get your thoughts on what we can expect down the line in the next 2 quarters for the year in terms of liquidity for the market.
So far this year, we've seen the CBN tighten, have a tightening monetary policy stance, which has significantly reduced liquidity in the money market and has then, filtered into the fixed income market, which is why we have higher yields. For the rest of the year, it is our belief that the CBN would continue to maintain this stance, particularly given the levels of inflation that we have in the country at the moment. Their key focus right now is to tame inflation, and they're trying to achieve that by maintaining a tightened policy stance. And, that's just, making them keep a very close eye on the liquidity in the system as far as the money market goes, and as far as that sort of flows into the fixed income market. So we don't start to see fixed income yields decline significantly from where they are trading today. So just to give a summary, I would say that we'd expect that the CBN will continue to maintain its policy stance for the next 2 quarters in a bid to fight inflation.
All right, but looking at the market, in hindsight, in terms of the reforms that we've seen play out from the central bank governor, the higher interest rate environment, let me get your take on the performance of the market in the first half of this year, especially with the central bank saying that we're seeing improved inflows coming back into the market.
Yeah, that is correct. We have seen increased inflows and increased activity in the official FX markets. We've seen the market reflect demand and supply more actively, right? This has been a direct result of the higher interest in the environment that we have. Yes, because we have a situation where foreign portfolio investors are bringing in FX to convert to Naira and then invest in the higher treasury bill yields that we have, or even some touch the shorter end of the bond curve. So we've seen a lot of more activity on the FX market. So as far as that goes, we can say that the CBN's policy for a higher interest rate environment has, at the very least, increased activity in the official FX market and liquidity.